KK, so what's your sense? What's going to provide trigger to the markets besides, of course, the global data point in terms of what comes about from the fiscal cliff deal?
I think the biggest game changer which I think can come from locally would be how successful is the direct cash transfer scheme which is going to be implemented from 1st January onwards, and what kind of success we see and how the rollout happens. Because if it is successful, then it could be a very positive big trigger, and by the year end possibly you will see the whole country being under the direct cash transfer. That's one big trigger I see on a fiscal side which could significantly re-rate the markets. Otherwise there are the usual suspects that you expect interest rates to come off going forward, and that should give a positive trigger to the markets in terms of valuations. But these are the two events, and thirdly, in terms of the budget expectations, I believe that if the way the government has been going about in terms of various introduction of various bills, if they are able to manage to introduce the GST bill in the budget, etc., that could be a significant positive triggers for the market.
KK, when do you think Indian markets will be convincingly trading above its previous high of 6100, 6200?
Frankly speaking, does it matter whether it's at 6100 or whether it's 5850 or 5900? These are psychological benchmarks, psychological numbers, and if we believe that this year we should be up by around 15%, or somewhere during the year we should be able to cross the 61, 6200, which is more of a psychological number. So that's the way I look at it. But if the momentum builds up in the first few months of the next calendar year, then possibly we should be able to cross those numbers before the end of February.
Now, if I look at the Bloomberg consensus, the Sensex earnings, according to Bloomberg, for FY14, they are likely to grow in the region of about 10 to 14%. 10 is the most pessimistic target, 14 is the most optimistic target. So do you think at the current level, based on FY14 estimates, and with the assumption that we could get a rate cut, or we will rather get a rate cut from Reserve Bank of India come Jan 2013, do you think all the good news is priced in, all the good news is baked in?
As I said in the beginning itself, from here PE expansion should be a challenge because of you have your elections in 2014, etc. So basically, at best you can expect is earnings expansion, or your Sensex should appreciate to the extent of your earnings growth, which is around 12 to 14%. For any PE expansion, etc. to happen, you would have to have some significant positive expectation building up going forward. Then I think investors will start discounting FY 14-15 in advance, and then we could possibly see a PE expansion. Otherwise, on a valuation front, markets are reasonably valued.
KK, as of now it appears that for 2013 we could be staring at abundant global liquidity, and in the light of what's happening in Brazil, Russia and China, Indian markets clearly will continue to get disproportionate amount of money. So if Indian markets, they continue to attract strong global liquidity, could we be staring at a PE expansion?
Possible. It's possible. One is, I think, if we get decent global liquidity, and the expectations are very there, but then we have a decent amount of supply of paper also expected, and so that should be able to help, absorb the amount of global liquidity which is expected to come to India. But I think it also helps to improve the liquidity, improve the market cap of the companies or the float of the companies where there are these issuances. So I think global liquidity itself cannot take your P's beyond a point. It also finally fundamentals have to come in play, and so that would be a key trigger for PE expansion. To some extent, global liquidity can help, but beyond the point, I think fundamentals finally come into play.
KK, what about the IT pack as such? What do you think we are going to see by way of earnings come next month?
There have been guidances where, expectations are there that some of the IT majors will disappoint, and one of the IT majors has said that everything is on track. But having said that, valuations look reasonable, but growth looks challenging. So many of the mid-cap IT stocks also we have seen correct significantly in the last 1 month or so. I think the whole sector is under challenge, and it could be under pressure in terms of stock price for some more time.
KK, if I take the clock back, I distinctly remember when we started the year 2012, expectations were low. We were freely using words like policy paralysis. But as we roll over to the year 2013, expectations are high. Forget about finding a bearish report. I would say 10 on 10 market men are bullish for 2013. Do you think expectation management will be a key challenge for next year?
Absolutely, you have hit it on the head. Last year, at the beginning of 2012, I don't think so anyone would have expected 22 billion or $20 billion of FII inflows, and for the markets to be up by 25-30%, which is what the case is today. So yes, the expectations are very high. No doubt in the last few months, a lot of execution on the policy front has happened, and the expectations have got built in. So that's a significant, if you say the biggest risk to the market is if there is any disappointment in terms of execution on ground level, then there could be challenges. Today the expectations are reasonably high in terms of execution from the government front.
KK, markets never oblige the majority. The majority opinion is that for next year we are in for 10 or a 12% gain. What to your mind are the chances that next year we actually could be in for a blowout year? The liquidity stress setting is strong. If we get a strong budget, if Reserve Bank of India obliges, you never know.
I wouldn't like to hazard a guess. I think we might as well play on a quarterly basis in terms of how things are panning out. But having said that, every year you find your stocks amongst the Nifty or amongst the large mid caps, etc., which have given very good returns. So it's good to look at the Nifty performance, etc. But finally, it all boils down to the individual stock selection, and that's where the money is made by all investors. So having said that, we have identified some of these sectors which we have discussed earlier, which could possibly be big beneficiaries if there is a positive uptick in the economy, as well as if there are significant global liquidity flows. So those are the sectors which could give you much better returns than the Nifty.
Discuss names, KK, because you are insisting that for next year we should focus on stocks. You're giving me sectors, you're not telling me the names.
See, we have talked about public sector banks, so that's the one sector which looks good. Among that, the largest banks, whether it's the State Bank of India or whether it's the Punjab National Bank, they should give you good returns in the coming forward. And housing finance companies, we are bullish on LIC Housing Finance. That should give you very good returns in the next 12 to 18 months. That's the time frame. And amongst agri inputs, we are bullish on Coromandel fertilizers. That's one stock which has not done well in the last 2 years. Now, on the low base, we believe that that's one stock which could give you very good returns. So these are some of the stocks, if you like to hear. These are the stocks that we are talking of.